You know, they say real estate is all about location, location, location. But in the world of institutional asset management, it's actually all about valuation, unsmoothing, and praying the terminal cap rate holds. If you walk into your exam and someone asks you why that Class A office space in a secondary market has a 4% cap rate, you don't answer with a number. You answer with a sensitivity analysis. Because in this industry, the thought is simple. Everything is a stable income-producing asset, right up until the moment the lease expires, and you realize you've just bought an expensive, oversized, non-refundable paperweight. Let's go.
Doc, if you don't master real estate returns, your portfolio might just become a very expensive paperweight. Are you ready to stop guessing and start calculating?
James, real estate is not merely a collection of physical bricks and mortar. It functions as a unique factor of production, distinct from standard equities or bonds. Because it is inherently heterogeneous, indivisible, and immobile, transfer costs are notoriously high. These characteristics render the asset class illiquid, complicating traditional valuation methods significantly. We must approach this with analytical rigor to understand its true investment nature.
Think of it like trying to sell a custom-built skyscraper versus 1,000 shares of a blue-chip stock. Stocks trade in seconds, but real estate sits there like a stubborn statue waiting for a buyer.
Precisely, and that infrequent trading creates a massive analytical hurdle for any serious investor. Since transactions are erratic, we often rely on appraisals, which act as lagging, smooth indicators of market value. These appraisals typically reflect a slow-moving average of past conditions rather than current, real-time market prices. This process creates a significant distortion in our volatility and correlation estimates. Consequently, the reported returns appear artificially smooth, which dangerously understates the actual underlying volatility. Failing to perform that unsmoothing process leads to spurious correlations with other assets. The smoothing effect masks the true timing of responses to economic data. You must apply a time series model to extract the true, observable returns that would manifest in a liquid market. This technique is standard practice for private equity, private debt, and hedge funds alike. Without this adjustment, your portfolio's risk-return profile will be fundamentally flawed and inaccurate. Real estate is inextricably linked to the business cycle because every business requires physical space. When economic activity rises, demand for housing services increases, putting upward pressure on rents and occupancy. Conversely, the supply of property remains effectively fixed in the short run. This imbalance triggers a cycle of development where rising property values and high occupancy induce new construction. Unfortunately, human optimism often leads to overbuilding, which inevitably initiates a painful, drawn-out bust phase.
That overbuilding is a killer because, unlike a burger joint, you can't just close a building overnight. It takes years to absorb that excess space because tenants have long, staggered leases.
That structural rigidity is precisely why real estate exhibits such persistent, long-term cycles compared to other assets. However, we must note that capital markets can sometimes override these fundamental cycles. During the global financial crisis, for instance, excess leverage and speculative investment accelerated the collapse. Appraisers responded to signals from REIT and mortgage-backed security markets, causing prices to fall much faster than historical trends would suggest. It was a departure from traditional slow-moving fundamental cycles. We utilized the capitalization rate, which represents the current net operating income divided by the property value. Think of the capitalization rate as a shorthand valuation metric, similar to the inverse of the enterprise value to EBITDA multiple for a corporation. This is not a direct cash flow yield because some income is reinvested into the physical structure. If you are tasked with calculating the required rate of return, you must sum the capitalization rate and the expected growth rate of the net operating income.
So if I know the income it generates today and how fast that income is growing, I can figure out the return. Is it really that simple, Doc?
It is simple under steady-state assumptions, but you must account for changes in the capitalization rate over time. The full formula adds the anticipated rate of change in the capitalization rate to that sum of income and growth. If the capitalization rate itself rises, it acts as a drag on your total return because it signals a drop in property value. Conversely, a compressing capitalization rate provides a boost to your realized returns. Always analyze these components separately to justify your valuation. Capitalization rates vary significantly based on property type, location, and the perceived quality of the asset. For instance, high-quality properties with long-term stable leases typically exhibit lower capitalization rates because they carry less risk. Conversely, lower quality properties or those in secondary locations often demand higher capitalization rates to compensate for their elevated risk profiles. Investors clearly demand a premium for the uncertainty of occupancy and potential rent volatility in these higher risk segments.
It sounds like I'm paying a worry fee in the form of a higher cap rate for buildings that might sit empty. Does the wider economy play a role here? Or is it just about the building?
The broader macroeconomic environment is a dominant driver because capitalization rates reflect long-term discount rates. Therefore, capitalization rates generally rise and fall in tandem with long-term interest rates, making them inherently pro-cyclical. Furthermore, you must consider the availability of debt. As real estate transactions rely heavily on leverage, when credit spreads widen or debt becomes scarce, the liquidity premium required by investors increases, which pushes those capitalization rates higher.
If the banks tighten their belts, the real estate market feels the squeeze immediately. What about the risks that turn a building into a potential headache?
Risk in real estate is multidimensional and requires a rigorous, systematic decomposition. First, realize that real estate has high effective duration, meaning it is hypersensitive to long-term interest rates, requiring a significant term premium. Second, there is a credit premium, as fixed-term leases function similarly to corporate bonds issued by the tenants. If the tenant is weak, the landlord must demand a higher credit premium to offset the risk of default.
What about the equity risk side of this equation?
That is the critical third component, James, because the owner bears the full burden of fluctuations in property values. You face inherent uncertainty regarding rent growth, potential vacancies, and the timing of lease renewals. When you combine these bond-like features, the term and credit premiums with the stock-like equity risk premium, you get a total risk profile. It sits comfortably between the risk levels of corporate bonds and pure equities. On the exam, if they ask you to compare this to other asset classes, emphasize that it captures both debt-like and equity-like risks simultaneously.
That sounds like a complex balancing act. But what happens when I need my cash back? How do I account for the fact that I can't just sell a building on an app?
You are referring to the liquidity premium, which is perhaps the most significant challenge in direct real estate ownership. Unlike liquid securities where price adjusts instantly, real estate suffers from an inability to sell the asset except at specific random points in time. Studies suggest this liquidity premium can range anywhere from 2 to 4% for commercial property. If you hold an asset that only trades every few years, that return expectation must be significantly higher to compensate for the inability to exit. If you want to incorporate real estate into an equilibrium model like the Singer-Terhaar framework, you must perform two adjustments first. You must remove the impact of appraisal smoothing from your return data, and you must add that liquidity premium back in. Without these corrections, your model will treat real estate as far less risky than it actually is, leading to an incorrect portfolio weighting.
GPS check. We've covered the appraisal trap, the economic cycles, and why you need to juice your return expectations for the lack of liquidity. What about the debate between buying a building yourself versus just buying a bunch of REIT shares?
That is a common point of confusion for many candidates, James. Institutional investors with massive scale might build portfolios of direct real estate, but smaller investors often turn to real estate investment trusts or REITs. REITs provide a financial instrument to gain exposure to real estate without the burden of direct management. However, assessing if these are truly comparable requires deep, firm-by-firm analysis. You cannot simply look at the headline returns. You must account for leverage differences.
So if I'm looking at a REIT, I need to see under the hood at their debt levels before I compare it to a direct property?
You must perform a firm-by-firm deleveraging of the REIT returns. Once you strip away the effects of their debt, the volatility of REITs drops significantly, often being cut in half. When properly adjusted, the performance of deleveraged REITs becomes remarkably similar to that of direct unlevered real estate. Some studies even show that REITs can outperform direct real estate by a few basis points while offering lower volatility.
So the REIT is essentially a proxy for the direct market, provided I adjust for that leverage. What about diversification? I always hear that real estate is the ultimate hedge against stocks.
That is a pervasive myth, James, driven largely by those smooth appraisal returns we discussed earlier. In the short run, REITs trade like equities and exhibit very high correlation with the stock market. However, if you look at longer time horizons, REITs demonstrate behavior that is much more consistent with direct real estate. The diversification benefit exists, but it manifests differently than many investors expect. You are not buying an uncorrelated asset. You are buying a long-term real estate exposure that happens to be liquid. You must be very precise on the exam when asked to justify the role of real estate in an asset allocation. Always distinguish between short-term correlations, which are high for public REITs, and long-term fundamental drivers. If you do not account for the smoothing of direct real estate data, you will mistakenly conclude it offers diversification that does not actually exist. This requires a deep understanding of how liquidity constraints and market structures influence reported return series.
Got it. So don't let the smooth data fool you into a false sense of security. Now let's talk about the biggest piece of the pie, housing. What does history tell us about residential real estate?
Residential real estate is massive, accounting for approximately 75% of the total value of global developed properties. A comprehensive 145-year study found that over the long term, residential real estate actually outperformed equities while exhibiting significantly lower volatility. However, you must be careful not to generalize this performance across all time periods. The relationship shifted dramatically after World War II, changing how these assets move in relation to one another.
So the best performer title comes with a disclaimer? I'm listening. What changed after the war?
Before the war, residential real estate and equities were highly correlated, moving in lockstep. After the war, that correlation dropped, making residential real estate a more effective diversifier. Interestingly, while equity returns became increasingly correlated across different countries, residential real estate returns remained essentially uncorrelated globally. This is a crucial distinction for a global portfolio manager. Global stocks may move together, but local housing markets often do their own thing.
If I own houses in 10 different countries, I'm not really exposed to one single global factor like I would be with stocks. What's the catch for an investor looking at these historical returns?
The catch is the shift in relative performance over the last few decades. While residential real estate outperformed stocks between 1950 and 1980 in many countries, that trend reversed between 1980 and 2015, where equities generally took the lead. You must analyze these returns within their specific historical context to avoid drawing incorrect conclusions about future expected performance. The data shows that no single asset class guarantees superiority across every epoch of economic history.
Doc, let's dig into the business models of these three firms. If I'm evaluating office growth partners, they seem to be chasing the next big trend. Is that a winning strategy?
It is an incredibly high-risk strategy, James. Office Growth Partners targets hot speculative markets and builds generic office space, which lacks any unique competitive advantage. Their typical tenants are opportunistic sales forces who are likely to terminate leases the moment the economy softens. This structural weakness makes their cash flows extremely volatile and subjects the firm to persistent vacancy risks. Consequently, any prudent investor must demand a significantly higher expected return to compensate for this elevated business risk.
That sounds like a recipe for disaster when the cycle turns. Contrast that with megabox properties. They build custom distribution centers for global brands. That feels much more like a defensive play.
Megabox Properties operates with a far more stable business model due to their strategic focus. By creating custom-designed facilities in major transportation hubs, they build deep functional interdependencies with their multinational tenants. This customization creates high switching costs, which inherently leads to longer-term lease agreements and lower tenant turnover. These features benefit both the landlord and the tenant, creating the stability that investors prefer. Therefore, you would justify a much lower required rate of return for megabox compared to the office project.
So customizing the asset creates a moat around the business. What about exclusive elegance? They have that 85% pre-sale rule before they break ground. Does that hedge out the risk?
Exclusive Elegance Inc. demonstrates a highly disciplined development strategy that directly mitigates market risk. By ensuring that at least 85% of units are sold before construction begins, they effectively eliminate the danger of holding vacant inventory in a declining market. This pre-sale requirement ensures they have the capital to complete the project without being overly reliant on debt. However, you must remember they are still operating in the ultra-luxury residential market, which can be highly sensitive to broader economic shifts despite their disciplined process.
Doc, you've been a lifesaver today. I've got my notes on the leverage, the lease quality, and these specific business models. I'm ready for the next challenge.
Excellent, James. Now, let's pivot to the command words you'll see on the exam. If the question asks you to justify a choice, you must explicitly link your conclusion to those structural risks we just analyzed. For OGP, you would justify a higher required return by citing the persistent vacancy risk and the boom-bust cycle sensitivity of their office assets. For Megabox, you would justify a lower return by referencing the stability of long-term leases and the high switching costs created by their custom designs. The exam rewards candidates who demonstrate that they understand the underlying mechanism of risk. Do not simply list features, explain how those features translate into income uncertainty or liquidity demands. When justifying your return expectations, always mention how the asset's specific competitive position, like Exclusive Elegance's pre-sale discipline, effectively lowers the risk of the development phase and justifies a more favorable valuation.
That makes total sense. Now let's talk about the Singer-Terhaar framework again. I know we touched on it, but how do I explain the integration of real estate into a global asset allocation?
To integrate real estate into the Singer-Terhaar framework, you must recognize that it is not perfectly integrated into global capital markets. You must treat it as a partially segmented asset class, which means you have to weigh both its global risk premium and its local asset-specific risks. Because real estate is illiquid and immobile, the local market supply-demand dynamics significantly influence its risk premium, which you must blend with the global market risk based on the degree of market integration you assume. The framework allows you to account for this by incorporating a premium for the asset's illiquidity, which we discussed earlier as the 2 to 4% range. If you ignore this segmentation, your model will wrongly assume that real estate should have the same return characteristics as a liquid equity. Always demonstrate on the exam that you understand how to adjust the theoretical framework to account for the unique physical and local nature of the property.
This is getting deep, Doc. What about the appraisal smoothing again? I need to make sure I don't get that wrong on an essay question.
On the exam, if they show you a table of returns and ask you to critique them, immediately point out the smoothing bias. Explain that because appraisers use past prices to estimate current value, they introduce a significant lag. This lag causes the returns to show lower volatility and higher autocorrelation than they would in a truly efficient transaction-based market. Your answer should explicitly state that the reported correlation with other assets is artificially low because of this data limitation. You must argue that to reach an accurate asset allocation, you need to use an econometric procedure to remove that bias. Once you unsmooth the series, the true volatility of real estate will emerge, and its correlation with stocks and bonds will likely increase. This is the mark of an advanced candidate who doesn't just take the data at face value but understands the mechanics of the valuation process itself.
I'm starting to think unsmoothing is just the industry's way of saying, let's be honest with ourselves. But let's move to something concrete, the income part of the returns.
That income stream is your anchor, James. Remember, in commercial real estate, the net operating income, or NOI, is the foundational revenue source. It is calculated by taking total potential rental income, subtracting vacancies and credit losses, and then deducting all operating expenses. If you don't calculate this precisely, your valuation is worthless because the cap rate is only as reliable as the income number it divides. Always double check if your income projections include realistic vacancy rates or if they are just optimistic targets.
Optimism is a dangerous drug in real estate. What happens if the building is full of long-term tenants but the market rents are skyrocketing? Does the building value go up instantly?
Not instantly, because those long-term fixed-rate leases create a rent gap. The current income is locked in, so the asset behaves like a bond with a fixed coupon. However, the value of the building will reflect the asterisk present value, asterisk of those locked-in rents, plus the anticipated future market rents. This is where analytical thinking is crucial. You must differentiate between the cash flow you receive today and the market value of the lease contract itself. If you're justifying a valuation, point out how the lease structure influences the stability of that income. Management is a hidden cost and a hidden value driver, James. High-quality management companies reduce the friction in your income stream. They keep maintenance costs low and occupancy high, which directly increases the net operating income. When you evaluate a real estate firm, look for their track record in keeping operating expenses consistent relative to the gross income. If those costs are creeping up, your margins are shrinking, and your property value is taking a direct hit.
So management isn't just a line item, it's a performance indicator. Doc, what about the exit cap rate? That seems like the most speculative part of the whole formula.
You are absolutely correct. The exit capitalization rate is an estimate of where the market will be at the end of your holding period. Because it is a forecast, it is highly sensitive to interest rate expectations and economic outlooks. On the exam, if you are asked to determine the return, you must explicitly state that the exit capitalization rate is the most significant source of forecast error. You need to perform a sensitivity analysis to see how even a small shift in that terminal cap rate changes your entire project's profitability.
So it's the biggest variable and the one I have the least control over. That sounds like a trap waiting for me on the exam.
It is a trap for the unwary. Yes, a classic exam question will ask you to justify the terminal value assumption. Your response should highlight that you are factoring in potential changes in interest rates and market liquidity. If you simply assume the exit cap rate is the same as the current cap rate, you are likely failing to perform a professional analysis. Always acknowledge the uncertainty and provide a range for your terminal value to show you understand the what-if nature of real estate returns.
Got it! Never assume, always model the range. Let's shift to the physical versus financial aspect. Is real estate truly just a factor of production like you said earlier?
It is, James, and that is a crucial distinction. Unlike stocks or bonds, which represent claims on future earnings, real estate is a physical asset that provides a flow of services in a specific location. Because of this, the demand for real estate is derived from the demand for the goods or services produced within it. When you analyze a property, you are implicitly analyzing the success of the businesses operating inside. This is why you must understand the broader economic drivers, not just the building itself. And because the asset is immobile, you cannot move your building to where the growth is. You are geographically tethered to your investment. This is why local economic conditions, such as regional demographics, local government regulations, and labor market trends, are just as important as the global economy. On the exam, if they ask you to evaluate a property's outlook, always consider the local economic factors alongside the national or global macro trends.
Local micro trends matter as much as the global picture. What about the indivisibility problem? Does that lock me into a specific risk profile?
Indivisibility means you cannot buy a fraction of a building in a way that perfectly diversifies your risk. You have to take the whole package, the location, the tenant, and the physical state of the building. This is why institutional portfolios require such massive capital. They have to buy many different properties to achieve the diversification that an equity investor gets with a single index fund. Understanding this helps you justify why larger firms have a structural advantage. Transfer costs are the hidden killers of real estate returns. They include brokerage fees, legal expenses, transfer taxes, and the time value lost during the lengthy closing process. These costs are a significant drag on your IRR or internal rate of return, especially if your holding period is short. If the exam asks you to justify a holding period, argue that the transfer costs must be amortized over a longer duration to justify the investment. A quick flip is rarely profitable after you account for these frictions.
So real estate is a long-term relationship, not a casual date. I love the analogy, Doc. We've covered a lot, from the math of cap rates to the microgeography of the buildings.
We have, and you've navigated the complexities with excellent focus. The final takeaway is to always look at the asset through the lens of its physical reality and the contractual obligations of the tenants. Ever let the abstract formulas blind you to the fact that you are investing in a real physical structure that requires ongoing care and maintenance. As long as you maintain that grounded perspective, you will have a significant advantage on the exam.
Doc, let me ask, is the cap rate actually a discount rate?
That is a common misconception, James. A capitalization rate is just the ratio of current income to price, not the total required return. The discount rate is the internal rate of return that equates the present value of all future cash flows to the price. The capitalization rate only equals the discount rate if there is zero growth in income and no change in the value of the property. Always distinguish between the snapshot cap rate and the forward-looking discount rate when justifying a valuation.
So the cap rate is just today's snapshot, but the discount rate is the full movie? That's a great way to put it.
Precisely. The discount rate reflects the risk-adjusted return the investor demands for the entire life of the investment. You must account for expected growth in income, potential changes in market conditions, and the liquidity premium. If you only look at the cap rate, you are ignoring the future evolution of the property. On the exam, when you are asked to determine the return, always ensure you are projecting the total cash flows, not just the initial yield.
That sounds like a classic level 3 trap, using a snapshot to forecast a movie. What about the exit value? Should I use a terminal multiple or a discount rate?
You can use either, but the terminal capitalization rate is the industry standard for commercial real estate. You essentially capitalize the projected income in the exit year to estimate the resale price. However, be very careful with this exit assumption. If you assume a terminal cap rate that is too low, you are implicitly predicting a massive boost in terminal value. You must justify that exit cap rate based on long-term market expectations for that specific property type. The whole valuation is inherently subjective, which is why your justification on the exam is so vital. You aren't being graded on getting the right price, but on the analytical process of arriving at it. Show the examiner that you know how to stress test your assumptions. If your model changes wildly when you adjust the exit cap rate by 50 basis points, you must explain why that volatility exists. This demonstrates a deep analytical grasp of the risk. Remember, real estate is as much about the story of the property as it is about the math. A building in a prime location with a solid, long-term tenant has a different story than a generic office in a shrinking market. Your job as an analyst is to ensure the numbers reflect that story accurately. As long as you stay grounded in the fundamentals, you'll be ready for whatever the exam throws at you.
Is there anything else about global versus local in the real estate market that I might have missed?
Do not underestimate the role of global capital flows, James. When investors around the world seek a safe haven, they often flood major city real estate markets with liquidity, which drives prices up and capitalization rates down, even if local economic fundamentals don't fully support it. On the exam, if you see a mention of a global search for yield, link that to why cap rates might stay compressed in Tier 1 cities despite slower local GDP growth. This shows you can distinguish between local fundamentals and broader exogenous capital forces. You must always distinguish between the intrinsic value of the property based on its location and tenant and the market value influenced by global liquidity. Being able to explain that distinction demonstrates the level of critical thinking that Level 3 requires. If you are asked to formulate an opinion, mention both factors to show a balanced analytical perspective. It is the difference between a superficial answer and a truly professional one.
Doc, I think we have hit all the major bases. From the fundamental characteristics of the asset class to the advanced modeling techniques and the behavioral traps to avoid.
So remember, when in doubt, Blame the liquidity premium. It's the perfect excuse for why you're stuck with a masterpiece, and it makes you sound like a genius while you're waiting for the market to turn. And that, candidates, is why we don't just memorize formulas. We learn how to survive the market. Stay disciplined, keep your unsmoothing tools sharp, and we'll see you in the next module.